When you sell an investment for a profit, the government wants a cut. That cut is called the capital gains tax, and understanding it could save you thousands of dollars over your investing life. Most people have no idea how it works, so they accidentally pay far more tax than they need to. A few simple rules can legally shrink that bill dramatically. Let's break it down in plain English. Stick with me and you'll know exactly what a capital gain is, the two types, and why one is taxed far less, and the simple moves smart investors use to keep more of their profits. First, what is a capital gain? It's simply the profit you make when you sell something for more than you paid. Buy an asset, it grows in value, sell it higher, and that profit is your capital gain. This applies to things like stocks, funds, real estate, and other investments. The difference between what you paid, called your cost basis, and what you sold for is the gain the tax is calculated on. Now, a crucial point that surprises people. You're only taxed when you actually sell. If your investment goes up but you hold on to it, that gain is unrealized and it's not taxed at all. This is huge. As long as you don't sell, your money keeps growing untaxed year after year. The tax only triggers when you realize the gain by selling. Holding gives you control over when you pay. Now, the most important distinction in this entire topic. There are two types of capital gains, short-term and long-term, and the difference between them can dramatically change your tax bill. What separates them is simply how long you held the investment before selling. 1 year is the magic line. Cross it, and your profit is taxed in a completely different and much friendlier way. First, short-term capital gains. These come from selling an investment you held for 1 year or less. And brace yourself for the bad news. They're taxed as ordinary income at your regular income tax rate. That means a short-term gain is taxed just like your paycheck, which for many people is a high rate. Sell quickly for a profit, and the government can take a sizable bite. This is the expensive way to invest. Now the good news, long-term capital gains. These come from selling an investment you held for more than 1 year, and they get special, much lower tax rates. This is where smart investors live. Long-term gains are taxed at preferential rates that, for most people, fall well below their ordinary income rate. Depending on your income, that rate can even be zero. Patience is literally rewarded by the tax code. Think about that. The exact same profit can be taxed at a high rate, or a much lower one, based only on whether you held for under or over a year. 1 year of patience can save you a fortune. This is the single biggest takeaway. Whenever you can, hold your investments for at least a year and a day before selling to qualify for those lower long-term rates. It's one of the easiest tax wins there is. Selling just before the 1 year mark is one of the most common and costly mistakes investors make. If you're close to a year, it often pays to simply wait those extra days and cross into long-term territory. How much you actually pay on long-term gains depends on your total taxable income. Lower-income investors can pay zero, middle incomes pay a modest rate, and high earners pay the top long-term rate. This creates real opportunities. In a low-income year, like early retirement or a gap between jobs, you might realize gains at a very low or even zero tax rate. Timing your sales around your income matters. Now, a bonus most homeowners don't know. When you sell your main home, a large chunk of the profit can be completely tax-free. Singles can often exclude a substantial gain, and married couples even more. There are rules, like living in the home for a couple of the last several years, but this exclusion is one of the most generous breaks in the tax code. Your primary residence gets special, favorable treatment. Now, the most powerful move of all. Hold your investments inside tax-advantaged retirement accounts, and you can delay or even avoid capital gains tax entirely while they grow. Inside these accounts, you can buy and sell without triggering capital gains tax along the way. Your money compounds untouched by yearly taxes. This is a massive advantage over a regular taxable account. So a simple rule, use your retirement accounts first. Let your investments grow and get rearranged inside that tax shelter, and you sidestep a huge amount of capital gains tax over a lifetime of investing. Now, a clever trick called tax loss harvesting. If some investments are down, you can sell them at a loss and use that loss to cancel out gains elsewhere, lowering your overall tax bill. Your losses offset your gains, dollar for dollar. And if your losses are bigger than your gains, you can often use a portion to reduce your regular income too. A down market can quietly become a tax opportunity. Just watch the wash sale rule. If you sell for a loss and buy the same investment right back within a short window, the loss can be disallowed. Wait the required period or buy something similar but not identical. One more powerful rule, the step up in basis. When investments are passed on after someone dies, their cost basis often resets to the value at that time, wiping out the taxable gain for the heirs. This means decades of growth can pass to family with the built-up capital gains erased. It's a major reason some long-term investors choose to hold certain assets rather than sell them late in life. A word of balance. Taxes matter, but don't let them completely control your decisions. Avoiding a sale purely to dodge tax while ignoring your actual financial goals can backfire. The investment comes first, taxes second. Sometimes selling and paying the tax is simply the right move to rebalance, to reduce risk, or to fund your life. Be tax smart, not tax obsessed. The goal is more wealth after taxes, not zero taxes. A practical tip: keep good records. Track what you paid, including reinvested dividends, so you correctly report your cost basis. Overstating your gain by forgetting your true basis means paying tax you never owed. Most brokerages track this for you now, but always check. Accurate basis records make tax time painless and ensure you never overpay on profits that were partly your own money coming back to you. So pull it together. A capital gain is profit from selling an asset, and you're only taxed when you sell. Hold 1 year or less, and it's taxed as ordinary income. Hold longer, and you get much lower long-term rates. Hold for over a year whenever you can. Use tax-advantaged accounts to shelter growth, harvest losses to offset gains, and remember the home sale exclusion. Be tax smart, but let your real goals lead. Why does this matter so much? Because taxes are one of the biggest drags on long-term returns. Investors who understand capital gains keep dramatically more of their money over a lifetime than those who don't. You just learned moves that financial advisors charge real money to explain. Applied consistently over the years, these simple rules can be worth tens of thousands of dollars to your future wealth. So here's your next step. Before you sell your next investment, pause and ask, have I held this for over a year? That one question alone could save you a significant chunk of tax. Think in terms of after-tax wealth, plan your sales with intention, and lean on those tax-advantaged accounts. Small, smart choices today quietly compound into a much bigger nest egg down the road. Now I want to hear from you. What's your biggest question about investment taxes? Drop it in the comments below, and I'll help you make sense of it. And if this made capital gains tax finally click, give it a like, follow the channel for more plain English money lessons, and share it with someone who invests. Let's all keep more of what we earn.